Welcome to Financial Freedom FX. In today's video, we're diving deep into one of the most misunderstood yet powerful concepts in Forex trading, liquidity. Why does the market move suddenly? Why does your stop loss get hunted? And what are those mysterious price spikes? The answer to all these lies in liquidity. So stick around as we reveal how liquidity controls price and how smart money uses it to trap retail traders. Liquidity in Forex trading refers to how easily a currency pair can be bought or sold without affecting its price. In simple words, it's about how many buyers and sellers are available in the market. The more participants, the higher the liquidity. Pairs like EUR-USD or GBP-USD are highly liquid because they are traded by millions globally. On the other hand, exotic pairs have lower liquidity and can be more volatile. Liquidity determines how fast your orders are executed and how much slippage you might experience. High liquidity means smoother price movement and tighter spreads, which is ideal for scalping or intraday strategies. Low liquidity, especially during off-market hours, can lead to larger spreads and unexpected price jumps. This is why understanding liquidity is not optional, it's essential. Now let's talk about liquidity pools. Areas on the chart where pending orders are clustered. These are usually around obvious support and resistance levels, previous highs and lows, or psychological round numbers. Institutional traders look for these zones because they know this is where they can find enough orders to fill their massive positions. That's why you often see fake breakouts or stop hunts around these levels. It's the smart money filling orders from trapped retail traders. Have you ever placed a trade just to see price hit your stop loss and then reverse in your original direction? That's not a coincidence, it's a liquidity grab. Market makers and institutions intentionally drive price into these zones to trigger stop losses and activate pending orders. Once enough liquidity is collected, they reverse the market. Understanding this behavior helps you place your stops more strategically and avoid being manipulated. Let's break it down with an example. Imagine price is moving upward toward a recent high. Retail traders start buying in fear of missing out, while others place their stop losses just above the high. Now, smart money pushes the price slightly above that high, triggers the stop losses, collects liquidity, and then dumps the price downward. This is called a buy-side liquidity sweep, followed by a sell-off. It's not manipulation, it's how the market works. Liquidity isn't just found at highs and lows, it can also be event-driven. News releases like non-farm payrolls or interest rate decisions inject huge liquidity into the market. During these times, spreads widen and volatility spikes. If you don't understand liquidity dynamics, trading during news events can be extremely risky. Professional traders often wait for the liquidity grab to happen before entering a position. To trade with liquidity instead of against it, you need to think like smart money. Avoid entering at obvious breakouts or near swing highs and lows. Instead, wait for price to sweep these levels and show signs of rejection or a change of character. This gives you a safer entry with better risk to reward. Liquidity-based setups allow you to trade with momentum rather than against it. You can use tools like the volume profile, order blocks, imbalance zones, or fair value gaps to detect where liquidity might be hiding. Also, observing candlestick behavior around key levels, such as long wicks, engulfing candles, or sharp rejections, can signal a liquidity grab. The key is not to guess but to observe where the market structure tells you liquidity has been taken. Retail traders chase price. Smart money chases liquidity. This mindset shift is what separates professional traders from amateurs. By thinking about where the most orders are lying, where traders are most likely to get trapped, and where the market will move next to grab those orders, you begin to see the charts differently. Every price movement now has a reason. One common mistake traders make is placing stop losses too close to liquidity pools. This almost guarantees getting stopped out. Another mistake is assuming every breakout is real. Many breakouts are simply engineered liquidity grabs. The safest trades usually happen after the trap has been set and sprung, not before. Patience is your best tool when trading liquidity setups. Let's look at a real chart of EUR USD. You'll notice price consolidated near a previous high, then spiked above that level, taking out all stop losses before sharply reversing. That spike was a liquidity sweep. Smart money filled its sell orders where retail traders had their stops. If you had waited for the sweep and traded the reversal, your risk would be low and reward high. This is how liquidity can become your edge. Understanding liquidity is not a bonus skill in Forex, it's the foundation of price movement. Once you learn to identify liquidity zones, avoid retail traps, and align with institutional behavior, your win rate and confidence will improve dramatically. If you found this breakdown helpful, don't forget to like, subscribe, and share this video with fellow traders. This is Financial Freedom FX, helping you decode the markets one truth at a time.